Nothing. Nothing but. Nothing but net. Net.
Welcome to Nothing But Net, the podcast for triple net commercial real estate investing. Before we get into the meat of today's show, let's recap on why there's so much interest and buzz around net properties. Triple net properties are commercial real estate investments where the tenants, usually brand name corporations, pay you rent every month. Can you say mailbox money? In addition, they pay the real estate taxes, insurance, and maintenance for the property. No toilets, termites, or taxes. What's not to like? You can remember what net or triple net stands for by using TIM, taxes, insurance, and maintenance. With triple net properties, there's lower risk income and cash flow because rents are guaranteed by strong credit tenants. Preservation of wealth, because rent increases and property appreciation are bulwarks against inflation and a great store of value. Tax efficiency. The government wants investment in commercial real estate, so they provide inducements through depreciation and deductions which shelter income from taxation. Tax deferral, which gives potential for infinite tax deferral with 1031 exchanges, which are very popular in the triple net space. Triple net properties are a tangible asset, and as Mark Twain once said, buy land. They ain't making any more of it. Hello and welcome back to the Nothing But Net podcast, the podcast for triple net commercial real estate investing. I'm your host, Adam Carswell, joined by my co-host, Michael Flight, and we have a really special guest for you guys here today. His name is Matt Baer from Baer Real Estate Advisors. This guy has it all in terms of triple net properties. He has experience in triple net development, triple net brokerage. He does consulting for institutional investors and family offices on strategies as to how to allocate more of their funds into super stable, passive, cash flowing net lease properties. What we're going to talk with Matt about today are some of the tax benefits of owning real estate, and especially in his niche, which is 1031 exchanges. And to prove that that is his niche, guys, his phone number, which you can jot down right now, is 702-710-1031. So there you go. Michael, I'm going to hand it over to you now to give a little bit of a background and story on our friend Matt.
Thank you, Adam, for that fantastic introduction to Matt. We're going to have to give a little color on Matt. As you can tell, his area code is 702. He is an original Las Vegan. So
I'm a second generation Las Vegan. So I'm in the Wayback Machine.
Yeah. So, and Matt and I met quite a few years ago at an Urban Land Institute seminar on development in Washington, D.C. And we soon found out that we had a lot in common with our love of music, especially the blues, guitar, and especially guitar solos. So we are both mourning the loss. We're going to date this podcast, but we're both mourning the loss of Eddie Van Halen.
I listened to 3 Van Halen albums yesterday, so I am feeling the loss.
But with that, Matt has just been an excellent advisor to me in a number of different things. He's been an excellent dinner companion, and we periodically meet up at different International Council of Shopping Center meetings and also different triple net conferences and seminars. Matt, you just spoke at one of the largest triple net conferences and seminars just last month, didn't you?
I did. It was really interesting. It was the first virtual conference I'd attended and was one of the speakers at. As you know me, I like meeting people and really getting to know people and dinner and that whole conference process. I have to say I was really impressed with how quickly they adapted, and I thought they provided value. My particular on table was on medical real estate. And I had a couple of clients on as well, because I think that, for an experienced investor or someone who's looking for some diversification, medical real estate's a great way to get a little better yield and still have enough safety to feel comfortable about it. So yeah, it was, I miss being in New York and enjoying all of what New York is. It was certainly better than not having the conference. What did you think? You listened to some of it, didn't you?
Yeah, I thought it's excellent. I've been doing way too many Zoom calls and Zoom conferences, so I'm really wanting to get out and meet people and get in touch with people, because I think that's the better way to do it.
Absolutely.
So the first conference out of the box, I'm going to a family office conference that I was invited to speak at in Dubai at the end of the month. So
Wow.
we're looking forward to that, to talk about our triple net strategy. So, but can you, just before we get into the tax benefits, can you talk a little bit about the medical space? Is that offices? Is it Medtail? And what size properties? Give us a little variation on what you're doing there.
Yeah, I decided a few years ago that I wanted to develop a new channel of business that allowed me to get up to speed on the players in it quickly, understand kind of the risks and what made a good medical building different from a bad or an average building. And I thought it was a good space to Amazon's, and the retail credit is a great spot to have in your portfolio. After my research, you could get very good medical office buildings that are anchored or single tenant leased to a large doctor group, 10, 15, 20 doctor group. You can, buy that in the, mid sixes to mid sevens cap and get still the same stability, because doctors don't move very often for lots of reasons. One, there's a big investment. They don't like to move on their patients or clients.
Yeah.
So I just thought it was a way to get more return, and theoretically you're taking more risk, but I don't think you're taking, it's that whole idea, the difference between risk and perceived risk. I think it's perceived risk and not actual risk.
Yeah, I'm just going to interject here. Number one, they have an extensive build out, so they have to go duplicate that someplace else. And number two, if they've got patients that have been going to them for 10 years, if they move, those patients have to figure out how to get to them. So it's a real big thing. They've got employees that don't necessarily want to move either. The other thing that you brought up is those doctor groups. Some of them, most of them are high net worth individuals and highly stable. They're excellent credit. So that's really quite the niche that you're in there.
And it's a small, there's so many retail developers and retail owners. The medical universe, the top 50 buyers make up most of the transactions. I mean, it's for as much as happens in the space, it's with a few amount of people. So it's a good spot to get in and really balance out your portfolio. I don't know that if you were a new real estate investor, if a medical office building would be the first acquisition I'd make. But I do think it's something to consider. I've now been through probably $300 million of medical transactions, and I've learned along the way. And it does have its challenges, but you get paid to take them, if that makes sense.
Right. No, what you're saying with the cap rates, instead of somebody competing to get a Starbucks or something like that, they can just reach a little bit, get a much better return for their money, and really some excellent diversification that isn't going to go online, not going to be disintermediated by Amazon opening up a doctor's office and doing everything online and all the rest of it. So thanks for just explaining that a lot. I think that's going to add a lot of value to listeners out there, because a lot of people, they think of, well, I'm going to buy a McDonald's, or I'm going to buy a Burger King or a Popeyes, and that's about as far as they go with this.
I think the only one of the things to think about for people who are listening or thinking about portfolio construction, is that you really want to be in the $5 to $20 million space to get that kind of extra return. And it's interesting. Most medical deals, even for institutional buyers, are under 30 million. The entire business practically is between 5 and 20 million. If it's too small, you end up paying that compressed cap rate because there are more buyers who can buy it. So it's just, you have to really kind of understand your positioning within, the other competing buyers are.
Adam, what are we talking about today?
Yeah, well, thank you both for that back and forth. I'm sitting here as a young real estate Padawan, just absorbing the knowledge. So anyone who's tuned in, as you can see, this is going to be a very valuable episode. And Michael, I think I'm happy that we brought Matt on, because this is going to give us ideas in adding that next level of value as we grow the podcast and bring on other rock star guests. So more back to today. I think the first thing we want to hit on here is the tax efficiency that comes with real estate, the unique tax advantages. We've got a quote here from Tom Wheelwright, the legendary Tom Wheelwright, which is: the government grants tax and legal incentives to real estate investors to encourage them to do a job that the government can't. That's a nice, funny and true quote, I would say there. Michael, can you elaborate on why we wanted to kind of get things moving here with that particular quote?
There are so many great tax benefits to owning real estate. And the entire reason, this is internationally too, most developed countries and even undeveloped or developing nations have incentives to create more investment in real estate because they know that real estate creates industry. As Matt was talking about, you need places for doctors to practice, you need hospitals, you need all this stuff. And so that just contributes to a flourishing community. So the US government has extensive things that they do to provide incentives for people to develop real estate and to own real estate. And so we went through a few of those in the last financial analysis podcast, but let's go back through them again. The biggest one is that all your expenses that have to do with owning the real estate are tax deductible. So if you're having your accounting done, because the reason why we like net leases is that there's not a whole lot of expenses to be had. You still have your accounting, you still have your property management if you've hired a property manager. If you have to do a renewal with a tenant and there's a commission to be paid. So all those expenses directly related to the property are all tax deductible. In addition, if you put a mortgage on the property, so Matt was talking about anywhere from $5 to $20 million. The great thing about real estate is that you can leverage that. So if you've got a quality tenant, you can leverage that up to 75%. I don't do math very well, but on a $20 million property, if you were trading out of an apartment and you had $5 million, you could potentially buy a $20 million medical building. So that's just one of the benefits that you can't do with stocks or other types of investments. And then the really, really big tax saving is that properties depreciate. So as the property ages and stuff, the federal government knows that you have to maintain that property and that you can take a deduction for depreciation. And so even though it is a bookkeeping type of thing, you're saving your money so that once you have to do expenses or you have to, maintain the property, you've got that money theoretically available. In the meantime, once we buy one of these triple net properties, we can depreciate it over 39 and a half years. And there's some other things that you can do to accelerate that depreciation, like doing a cost segregation study. And so in the future, we're going to bring somebody on that does cost segregation studies, and they can talk to us a little bit more about that. The depreciation is a bookkeeping thing. So you might be getting $100,000 per year in income, but your depreciation might shelter that by up to $20,000. So you, in essence, would only be paying taxes on the $80,000, even though you're getting $100,000 in cash flow. Don't quote me on any of this stuff because I am, number one, not an attorney, and number two, not an accountant. So you're always going to want to talk to your professionals about how to structure these transactions. But those are just some of the benefits. And then the super huge benefit on real estate in certain other type of assets, but mainly real estate, is called the 1031 exchange. And that's where Matt is going to explain all this good stuff to us.
All right.
Thank you, Michael. You are definitely good at math. I don't want to hear that from you again. You're a math guy. Where would you like to start in 1031? As it's a big topic.
Adam, what do you know about 1031s?
Well, I know with the 1031 exchange, you have a certain time frame that you're working with. I think it's around 30? Is it 30 days?
It's 45 days to
45, right.
From the day you close on your real estate, you have 45 days to find a property, which we can get into too. But yes, I'm sorry, keep going.
Matt, why don't you tell us from the beginning, why would somebody consider doing a 1031? What's the purpose of it?
Sure. I think, like all investing, however you're doing it, it's what is my philosophy? What is my point of view? What am I trying to get to at the end of the day? Am I doing, is it for estate planning? Is it for tax deferral? Is it for building a portfolio? You really have to begin with the end in mind. And which is what makes 1031 a good opportunity for all of us, whether it's portfolio construction, tax deferral, or estate planning. It is the best way to use time value of money because your tax on any gain is deferred into the future. And unless they change the tax laws, if you continue to defer up until your death, hopefully that's a long time from now, your heirs get some form of stepped up basis. So I have a client of mine that says you swap till you drop. So it's like, he says it a lot funnier than that, but it's like, listen, if you're ultimately trying to invest for the future, invest generationally, you continue, you defer taxes until, again, the tax law can change at any time, but you get, your family gets stepped up basis, though your family may never have to pay the tax. So it is a very good generational investment tool for families and individuals, number one. In addition to that, even if you do and eventually sell a property and do not exchange, you still get the benefit of having that money accrue, via appreciation or cash flow, any number of ways that you're getting an increase in value, without getting the tax consequence. I mean, you eventually will get it unless it's a stepped up basis, like I mentioned, but essentially you get to continue to use your money without government interference, right?
Yeah. And actually, speaking of government interference, though, Michael, I know this is probably something we'll discuss on another show, but recently there has been talks politically of going after some of the tax money involved in a 1031 exchange. How would that negatively, because I know as real estate investors, that's something that we probably wouldn't want to take place. But what are the negative implications of that if that ever did happen?
I think what it would do is it could potentially depress prices because in a lot of situations, if you've got the capital out there and it's a way to have the capital flow most efficiently, but if you've got a lot of your money being taken off the table by the government, it might depress prices because people won't have that capital, or it'll make things much more competitive down at the lower end, which is where most investors start out, because they don't start out in the Matt Bear $20 to $30 million range. They start out in the $500,000 to $1 million range. And so it might increase prices there and reduce returns there. So it could be a host of things. Matt, why don't we bring it back to who typically does the exchanges? Why do they, what type of properties do they exchange out of, and what do they typically exchange into?
So I think the big thing is you can exchange any real property for any real property. So it could be an apartment for an industrial building, land for retail. It's any real property for any real property. Whether you're a tenant in it or you're not a tenant in it, I mean, it is obviously everyone needs to talk to their accountant, but it's actually very broad. And when someone is selling any property that will have a tax consequence, they should at least consider executing an exchange. So that's broad brush. Everyone needs to kind of think through that. And then it's, there's some very specific things that if you run afoul of them, you break your opportunity for creating an exchange, which again, we're talking about tax deferral of the gain of real estate. You have to set it up with an accommodator, some sort of a qualified intermediary that's the technical word for it. So you have to create the business relationship with the intermediary and make sure the escrow agent and the intermediary are on the same page. There's documents to prepare. So the money, if you sell a property, you cannot receive any of the money, literally not $1. So early on in my career, I used to have people would call me like, well, I've already closed. I've already received the money. Can I do an exchange? I'm like, no, you cannot. That's a rule. You've broken it. So it's really important that you get early on. And, a lot of times escrow agent can help you find a qualified intermediary. Many times the escrow agent company is a qualified intermediary, but you have to create that distinction. And then once you've done that, it's reasonably simple. You have 45 days to identify a property and 180 days to close on the property. You can actually identify up to 3 properties. And then there are rules. You have to put in a list with addresses and give them to your qualified intermediary. It's one of those things, if you're doing it without anyone's help, ask a lot of questions of the qualified intermediary.
That explains it a lot. What I've noticed in the 1031 market is in the net lease market versus other markets is there's a lot of multifamily owners out there that are getting towards the end of they're not interested in managing property anymore, and they're not interested in the toilets, the termites, or the taxes. So they want to take their gains off the table and go into something much more passive. And so that's why the triple net lease properties are very attractive for them. And then, as you had mentioned earlier, the generational planning, a lot of the kids don't want to start collecting rent checks or making, sure that the, stairs are swept or dealing with tenant, complaints. So they're like, yes, let's go into something where we get Walgreens or this doctor group just sending us a check every month, and all we got to do is open up the mailbox and look for that check.
Yeah, it's certainly simpler, right? I think there's always trade-offs. I mean, theoretically, as investors, you should get paid for the amount of effort you put into something. And so I think everyone has to kind of realize if you're doing less work, there might be less return.
Right.
And that may be just fine for everyone. But it's definitely a business where you have to stay engaged no matter what. Single tenant certainly is less. The important thing is, other than property condition, is lease expirations. And those things creep. All of a sudden, 10 and 15 years go by, and someone on your team, or hopefully maybe someone in the family, really has to understand the life cycle of the tenants and the real estate, and they're intertwined.
Yeah, and you bring up an excellent point, which we are going to get into at a later podcast, and it's going to be on property management, how to releases, what to do with renewals and releasing, because that's where I think a lot of, you are correct, absolutely. A lot of people think, I'm going to buy this and then I don't have to do anything and I don't have to know anything about it. And you do have to know certain things about it. And also, we're going to give them some negotiating tips as to what to do when the tenant comes back. Like Dollar Tree just did to me yesterday and said, hey, we'd like to, got an option coming up, but we'll give you a 10-year lease, but we want to decrease our rent. So we'll tell them, how we would respond to something like that.
I mean, luckily, Michael, you've had the experience to deal with the amount of rent reduction requests you've gotten this year. I'm sure even you have seen new requests from tenants, maybe justified or not justified. I bet it's been a very interesting year from that point of view for you.
The middle part of the year was spent, and I've said this on a podcast with the real estate guys. The middle part of the year was spent working with tenants that justifiably, were closed and they couldn't pay the rent. And so you have to work with them. And some of the national tenants were able to work with them and say, we'll give you a rent deferral, but you have to pay this back. And then that's why you'd rather have, especially on a triple net lease, some of the well-capitalized national tenants. We love our local tenants. And, we've had some local tenants that, we've had relationships for 25 years. And then in those situations, it's like, all right, this is what we'll do for you. And as long as you can pay the real estate taxes and the common area maintenance, because we'll take some hurt and you'll take some hurt. So yeah, that was an issue.
I've got a couple questions here for Matt too. I'm curious, through your experience, what are maybe some of the big mistakes that you or your clients have gone through that we can learn from today, so that way anyone listening who's entering into this realm can avoid it?
The biggest mistake I have seen and experienced from smaller investors, maybe it's their first reasonably inexperienced, is that they take 37 days saying no. They take 37 of the 45 days saying no to every opportunity. And then the last 8 days, they will say yes to anything. So my really experience is you actually don't need a great deal. You just need a good deal. And if you find a good deal on day 5 of 45, buy it, because it's when you get time pressure that you make mistakes. Of course, you can say that in life in general, right? I think it's like golf. Like if you have a bad shot, the next shot doesn't have to be great. It just has to be good. And you really have to understand when good's good enough. I know that's a broad brush, but the biggest mistakes are waiting too long and then getting stressed out and buying something that you shouldn't buy or could have negotiated, harder for, or some other time making you make less than optimal decisions. That's the biggest mistake. Beyond that is you really have to know what kind of investor you are. What is the outcome you're looking for? Are you buying this for pride because you can drive by it with your buddies? Is it, are you looking for yield? Or it's just, you have to really get in the mindset of, this is my return. This is what I'm getting or giving up for it to get that. How do I be a good steward of my own capital? Because it is not a buy it and forget it business. And no business is.
Nice. I really like that.
No business is. But I think people fool themselves into thinking that, but they don't do it twice.
Yeah, I really like that golf analogy. That's a good way to put it. And it's more of like a life philosophy too, if you look at it that way. Michael, did you have anything based on what Matt was saying?
No, so Matt, the entire life cycle of a 1031 is somebody has to have another property as a sell first, correct?
Yeah, you can do a reverse exchange, which candidly I've never done in my hundreds of deals. But there is a process where you could buy a property and then sell the property that you own, and that works. So there are attorneys and intermediaries that can walk you through that. It can be used very effectively. Most exchanges are someone sells their real property, and then they have 45 days to identify and then 6 months to close. I am not for touching the law in general, because anytime you change a law, it's Pandora's box, right?
Right.
However, if I had to switch, I'd give someone maybe not 180 days, but it'd be better to have 100 days to identify and 45 days to close, right? And if you're inexperienced, or maybe it's a horrible market and you're afraid to invest, or maybe the market's very competitive and prices are increasing only because there's more buyers in the market. That time frame sometimes does force you to make not decisions you wouldn't make again if you had more time.
Well,
that's the basics of it. So I'm sorry, go ahead.
I just learned something today, because I've never heard of a reverse exchange, and that's why we bring the experts on, because there's always something new to learn. Once somebody gets into the exchange, you had mentioned that the qualified intermediary. Could you talk a little bit about what that is, and if there's anything that people should be concerned about when choosing a qualified intermediary?
Most of the time, the qualified intermediaries are well insured and reputable and lots of transactions. It has happened, and it's happened in Las Vegas in the downturn, where an independent qualified intermediary took all of the money and went to Mexico. That literally happened. Yeah, so it was like a lot of money, and and then there's nothing you can do, because you're giving that money you're really giving it to them in a trust. So you definitely have to understand their insurance, what kind of bonds they've had to post, ask your escrow agent who they've used. Although it almost never happens where there's a problem, but it's happened. Never go into any deal saying it's okay to lose money, because that's when you lose a lot of money.
Right.
So I do not take risks on that. I go with the biggest intermediaries, and they tend to be attached to the title companies. Like Fidelity has a qualified intermediary, First American Title is a qualified. I mean, most of the big escrow and title companies have a qualified intermediary.
Yeah, you want somebody that's well capitalized,
bonded,
yes, so that that your money is there,
because it's really their money. I mean, it's obviously nuanced. It's their money why they've got it.
Right.
Now, they do, oftentimes there is an interest split. So they will pay you interest for the money that's in the account. That's actually how they get paid. Some of it's transaction fees, and some of it is, let's just say for fun, they're getting paid 2%. They'll pay you 50 basis points and they keep the difference. That's generally how they make money. So anyway, it's really important. It almost never is a problem, but you do have to do a little bit of homework. I personally always just pick one of the big, like if my escrow's with Fidelity, I tend to pick Fidelity qualified intermediary, just because it's what you're looking for is seamlessness.
Right. Less moving parts.
Well, yeah. Less people is always better than more people. Right.
Right. And then you typically would want to, at least if you're deciding to sell your property and you're deciding to do a 1031, you would at least want to do some homework on that before you sold your property, and then say, now what? Correct?
That's right. And really back to point of view and planning, which is the key of life anyway. When you decide to sell your property, you should be thinking about what kind of property do I want to buy next. So that 45 days is really 100 days, right? If a normal escrow is 45 to 60 days, you should be looking for real estate as soon as possible.
Right. So it goes, but you just hit on what Adam and I have talked about. It's creating an acquisition criteria, knowing what your target market is and knowing what the pricing in those areas are, knowing where you're going to go with that. So that's an excellent point that you bring up there.
And getting an understanding of the market, because as Howard Marks would say, the Oak Tree founder,
right?
You either do deals in the market or you don't do deals in the market. But what you can't do is want deals that don't exist. If someone says, Matt, I want a 10 cap, 15-year Walgreens, I'm like, well, that's amazing. I do too. There's none of those out there. And it doesn't matter how hard you want it. We wish for them. Like it's like you really have, like you always want to push reality because that's how you get a different reality.
Right.
But you have to understand the rules under which the game's played.
I think I've had most of my questions answered. Adam, do you have any more questions about, doing 1031s?
I think just going back to, learning from mistakes, another thing is, being proactive and being diligent. So I guess if you were to look at a deal or be in the middle of doing a deal right now, Matt, on your checklist, what are like the first 3 things that you focus in on as a professional to make sure that the job gets done properly?
Understanding your risk, where you sit on the risk spectrum. That's always the first place to start. I'm going to give you a couple more because I'm going to roll now.
Cool.
The other thing is what you desired return is, and this is a little more, I don't know, it's not sophisticated, but most smaller investors don't think this way. Larger investors must think of it as like, what is my target rate of return? And then, of course, how much risk am I willing to take to get that? And then you just have to go into the market. And the only way to buy more real estate is to make more offers, is don't be afraid to make offers. Like they're almost always a non-binding letter of intent, and which cuts both ways, but you just have to keep engaged in the market, keep making offers, get feedback, and develop relationships. And you also do have to understand that if most of what I do on the brokerage side is I'm representing the buyers almost always. If you're working with the seller's agent, and there's great ones out there, but you really have to know that the seller's agent is looking for you to pay the absolute most they can for that piece of real estate, because that's their job. They're not doing, so even if the best ones, their job is to get you to pay the most. And so if they say it's $10 million, don't make an offer. And if you want to make a $7 million offer, make a $7 million offer. Don't phone negotiate yourself out of a deal because you're listening to someone who doesn't represent you. I know it sounds weird, but even the most sophisticated investors forget that the listing agent isn't their friend. I mean, right. I don't mean that literally, but
yeah, no, I just want to, because there are, as you said, there's excellent brokers out there, and I've been a broker for probably about 35 years now. And the key thing that everybody needs to bear in mind is if the listing broker, their fiduciary responsibility is to the owner and not to you, even though they say, oh, I can get you in on this or blah, 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 blah. And then, as Matt said, that's golden right there, is that their commission is usually higher based on how much they get you to pay for the property. And I know most people know that, but it doesn't hurt to reiterate it.
Absolutely.
Yes. So I think it's just really doing your homework. And I also say this, I really believe the real estate business is best played as a portfolio. Because, so one bad, because real deals go bad, tenants go out, like it happens. I'm a believer in a portfolio, having more than one property. I also believe in, investing with the right sponsors. There's a few ways you can use exchange dollars into going into investment companies. They're called Delaware Statutory Trusts or tenants in common, or other ways using an LLC. There's other ways that you can invest with other people and still preserve your exchange. Again, especially if you're trying to do less work in your life, finding a good sponsor is actually a very good thing to do. So there's other options for you to do this. So anyway, I throw that out because it's important. You have options. You just have to look for them.
Right. And I'm going to do a shameless plug, but that's why Liberty Fund, we really wanted to do was take advantage of the stability of these triple net properties, but also diversify from a geographic, in an industry, and also a credit standpoint. So you bring up some excellent points there. And I just also want to say that if you are just getting into the market, you can shortcut a lot of your homework by going to Matt Bear or somebody like Matt that represents buyers, because they're constantly in the market, so they can kind of guide you on what the pricing is, what the hot areas are, what might be some other things. Since Matt is constantly working with other brokers and working with owners that are selling things, he's privy to a lot of knowledge that, because he's in the flow of it.
Thank you. And yes, you bring on people you trust as soon as you can.
There we go. Real estate is a business of collecting people that you like, know, and trust. That's a quote from Matt Baer on episode 106 of Dream Chasers. Yes, Michael, I just did a shameless plug as well.
I was feeling smart that day, apparently. Doesn't happen very often. Well, thank you. I've really enjoyed this. Hopefully, I've added value to everyone.
One more time, the best way to contact you, Matt, for anyone tuned in?
Yeah, thank you. It's 702-710-1031. 702-710-1031.
What is your website address also?
Sure. It's Bear, BEAR hyphen sign, and then advisors, ADVISORS.com. Bear-advisors.com.
Yeah, because they can see a lot more about some of the deals that you have done and some of your extensive experience and all the rest of it. But I just want to thank you for coming on. That's why we branched out and started bringing in specialists, because while we do know a lot about certain things, it's really when you get somebody with not only the experience, but the knowledge of Matt, it really works well. And I've just got one more Las Vegas question for you.
Yes.
And that is, how do you feel about the triple net deals that they did with the casinos out there?
Well, I mean, at the time, they looked genius, right? Because it's, ultimately, they're going to be just fine, right? I mean, they're going to generate enough cash to pay the ground leases. And even if they can't, no one's going to, the senior lien holder isn't going to let the ground lessor, take the building back. So I think it was appropriate. I think it was a very inexpensive way to raise a lot of capital, not having to go to the bond market so it's overall, they were, for the hotel side, it was very smart. And I think on, Blackstone, who really had bought them, or VC, which formed a REIT, they're what they intended to be. They were low yield, high safety, and having exposure to the market. Of course, today that's less pretty than it was. This too shall pass.
Yes, absolutely. Thank you.
You're welcome. Thank you.
All right, everyone, thank you for investing your time with us here today on the Nothing But Net podcast, the podcast for triple net commercial real estate investing. I'm your host, Adam Carswell, alongside co-host Michael Flight and our fantastic guest today, Matt Baer, the 1031 Wizard. We will catch you guys in the next episode. Thank you once again for joining us here on Nothing But Net, the podcast for triple net commercial real estate investing. If you enjoyed what you heard today, one last friendly reminder to like, share, subscribe, or leave a review for us. It really helps a ton with the show's visibility. For the Nothing But Net team, I'm Adam Carswell. Take care.
Nothing but net.
The Nothing But Net podcast is not intended to provide legal, tax counsel, or accounting advice. Adam Carswell, Michael Flight, Concordia Realty Corporation, Liberty Real Estate Fund, LLC, and their affiliates do not provide tax, legal, or accounting advice, or the worthiness and promotion of any particular investment. This material has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction or undertaking. We highly encourage individuals and investors to seek the counsel of a qualified attorney as well as seek the counsel of a tax professional or certified public accountant to determine if there are any potential tax liabilities or consequences as a result of anything contained herein. All listeners of this podcast or video should understand that there are no guarantees of any success, outcome, or profitability of any transaction or undertaking, expressed or implied, and will not be liable for any financial or other losses or damages incurred as a result of any undertaking. Go to nothingbutnet.us for a complete set of disclosures. Thank you.